Imagine owning a tiny piece of a big company like Apple or Amazon. These companies are giants in the tech industry, and having a stake in them means you are part of their journey and growth. It's like having a small slice of a very large pie. That's what a stock is. A stock represents a fraction of ownership in a company. When you own a stock, you own a piece of that company, no matter how small. When you buy a stock, you're buying a small share of ownership in that company. This means you have a claim on part of the company's assets and earnings. Essentially, you become a part owner of the company. This makes you a shareholder. As a shareholder, you have certain rights, such as voting on important company decisions and receiving dividends if the company decides to distribute profits. Companies sell stocks to raise money for growth. By issuing stocks, companies can gather the necessary funds to expand their operations, invest in new projects, and improve their products and services. They use this money to develop new products, open new stores, or hire more employees. This influx of capital can be crucial for a company's growth and success. As a shareholder, you can benefit from their success. When the company performs well, the value of your shares can increase, leading to potential financial gains for you. When a company does well, its stock price goes up. This increase in stock price reflects the company's improved performance and profitability. You can then sell your shares for a profit. This is one of the primary ways investors make money in the stock market. This is how you make money in the stock market. By buying stocks at a lower price and selling them at a higher price, you can achieve financial gains. But remember, stock prices can go down too. The stock market is volatile, and prices can fluctuate based on various factors, including market conditions and company performance. If a company doesn't perform well, its stock price may fall. This can result in losses for investors who own shares in that company. Investing in stocks involves risks, but it also offers the potential for rewards. Diversifying your investments and understanding the market can help manage these risks and maximize your potential returns. Why should you care about stocks? Because they can help you grow your money faster than traditional savings accounts. Savings accounts offer low interest rates, often failing to outpace inflation. Stocks, on the other hand, have the potential for much higher returns. Over the long term, the stock market has historically outperformed other asset classes. This means your money has the potential to grow at a faster rate. Of course, there are no guarantees in the stock market, but history has shown that investing in stocks can be a smart way to build wealth over time. Investing in the stock market offers several benefits. First, it can help you grow your wealth over time. As companies grow and become more profitable, their stock prices tend to rise. Second, investing in stocks can help you stay ahead of inflation. Inflation erodes the purchasing power of your money over time. Investing your money can help you combat this. Third, investing in stocks can provide you with a source of passive income. Some companies pay dividends to their shareholders, which are a portion of the company's profits. Getting started in the stock market is easier than you think. Many people are intimidated by the idea of investing, but it doesn't have to be complicated or overwhelming. With the right approach and a bit of knowledge, anyone can start investing and potentially grow their wealth over time. You don't need to be a financial expert or have a lot of money. In fact, many successful investors started with very little and learned as they went along. The key is to start with the basics and build your knowledge and confidence over time. Here are a few simple steps to get you started. First, open a brokerage account. This is your gateway to the stock market and will allow you to buy and sell stocks. Opening a brokerage account is straightforward. You'll need to provide some personal information and choose the type of account that best suits your needs. Many online brokers offer user-friendly platforms that make the process easy. This is like a bank account for your investments. It holds your money and the stocks you purchase. You can transfer funds from your bank account to your brokerage account to start investing. There are many online brokerage platforms that make it easy and affordable to buy and sell stocks. Some popular options include Robinhood, E*Trade, and TD Ameritrade. These platforms often offer educational resources to help you learn as you go. Second, start small. You don't need to invest a lot of money when you're first starting out. It's important to only invest what you can afford to lose. Starting with a small amount allows you to learn without taking on too much risk. Begin with an amount you're comfortable with and gradually increase your investments over time. Consistency is key. By regularly adding to your investments, you can take advantage of dollar-cost averaging, which can help reduce the impact of market volatility. Third, do your research. Before you invest in any stock, take some time to learn about the company. Understanding what you are investing in is crucial to making informed decisions. Look at their financial statements, read news articles, and understand their business model. This will help you gauge the company's potential for growth and its overall stability. Remember, investing is a journey, and the more you learn, the better your chances of success. Section 5. Long-term investing. Patience pays off. One popular investment strategy is long-term investing. This involves buying stocks and holding on to them for an extended period, typically 5 years or more. The idea behind long-term investing is to ride out the ups and downs of the market and benefit from the long-term growth potential of stocks. It takes patience and discipline. When you invest for the long term, you're less concerned about short-term market fluctuations. You're focused on the overall growth of your investments over time. Section 6. Diversification. Don't put all your eggs in one basket. Another important investment strategy is diversification. This means spreading your money across different investments to reduce your overall risk. Don't put all your money into just one or two stocks. If those stocks perform poorly, you could lose a significant portion of your investment. Instead, diversify your portfolio by investing in a variety of stocks across different sectors and industries. You can also consider investing in other asset classes like bonds and real estate. Section 7. Managing risks. Protecting your investments. Investing in the stock market involves risks. Stock prices can go down as well as up. However, there are ways to manage those risks and protect your investments. One way to manage risk is to invest for the long term. As mentioned before, this allows you to ride out short-term market fluctuations. Another way to manage risk is to diversify your portfolio. By spreading your money across different investments, you can reduce the impact of any one investment on your overall portfolio. Section 8. Seeking expert advice. When to consult a financial advisor. If you're new to investing or feel overwhelmed by the process, don't hesitate to seek professional advice. A financial advisor can help you create a personalized investment plan based on your financial goals, risk tolerance, and time horizon. A financial advisor can also provide you with valuable insights and guidance on a variety of investment topics, including portfolio management, retirement planning, and tax-efficient investing. Remember, investing is a journey, not a sprint. It's important to start early, invest consistently, and stay the course over the long term. Section 9. Conclusion. Your path to financial freedom. Investing in the stock market can seem daunting at first. The sheer volume of information, the fluctuating numbers, and the complex terminology can be overwhelming. Many people feel intimidated and unsure of where to begin. But remember, every successful investor started from scratch, just like you. But it's an essential step towards building wealth and achieving your financial goals. Investing allows your money to grow over time, potentially outpacing inflation and increasing your purchasing power. By putting your money to work, you can create a more secure financial future for yourself and your loved ones. Remember, you don't need to be a financial expert to get started. With the right resources and a willingness to learn, anyone can become a successful investor. Start by educating yourself on the basics of investing, such as understanding different types of investments, risk management, and the importance of diversification. By following the tips outlined in this guide, you can begin your investment journey with confidence. Start small, do your research, and gradually increase your investments as you become more comfortable. Utilize tools and apps that can help you track your investments and stay informed about market trends. And remember that patience is key. Investing is not a get-rich-quick scheme. It requires time and discipline. Markets will have ups and downs, but staying the course and maintaining a long-term perspective can lead to substantial rewards. Over time, you'll gain experience and knowledge, which will help you make more informed decisions. Keep track of your progress, learn from your mistakes, and celebrate your successes. The more you invest, the more confident you will become in your abilities, and your confidence will grow. As you see your investments grow and your financial goals come within reach, you'll feel a sense of accomplishment and empowerment. This confidence will motivate you to continue learning and investing. Don't be afraid to seek professional advice when needed. Financial advisors can provide valuable insights and help you develop a personalized investment strategy. They can also offer guidance during market fluctuations and help you stay focused on your long-term goals. Investing in your future is the smartest decision you can make. By taking control of your financial destiny, you can achieve the freedom and security you desire. Start today, stay committed, and watch your financial dreams become a reality.